afternoon, everyone, and welcome to Stock Market Today. It's Alyssa Corum and Ed Carson here. And on today's show, since it's Friday, we're going to break down the action for the major indexes, not just for today, but what happened this week and see if there's any clues that we can pick up to help us with our next week of trade. And we're going to look underneath the surface, take a look at a couple of stocks. There's still, Ed, some really great lessons to be learned when it comes to stocks that are wedging and potentially other areas of the market to look to as tech continues to be out of favor for the most part.
That's right, Allie. Very interesting week. We're going to take a look at Dick's Sporting Goods and Facebook, which did offer some buy opportunities today. Meanwhile, Novacure is one of those wedging stocks we've been talking about.
All right. Well, first, let's take a look at Thinkorswim, those candlesticks. And the NASDAQ saw a little bit of relief on Friday, up about 0.75% for the day. The Russell 2000 up about 0.9%. But we did see the Dow fall 0.7%, and the S&P 500 roughly flat, slightly lower for the day. So Ed, a little bit of relief for the NASDAQ, but not a great week by any means.
No, we had started the week, we were sort of holding above the 21-day line, going above the 50-day line. And then on Thursday, we came down really hard and went right through the 50 and 21-day. We did find support at the bottom of this, regression channel, sort of the full standard deviation. But, even with after a 3% loss, we came up 0.75%, as you say, and still below the 21 and 50-day line. And that's just not a good place to be living. I mean, it's like, you don't want your major indexes and your stocks living below that area. And that's what the NASDAQ and a lot of tech stocks are doing.
That's right. And, you were saying on IEBD Live how the NASDAQ at one point was just so resilient in this uptrend. It is a very different looking picture at this point. And the weekly chart is also very telling an interesting story here with the NASDAQ. What is this signaling to you?
Well, we had one nice little week last week, but it's still in the midst of all this selling. And I think that that's something we haven't really gotten above it. You can sort of see the high points for these for this last week. It's really pretty close to this area here as well. I think if the NASDAQ, you want to see that, and also the half standard deviation line. So I think if you shouldn't be too comfortable about the NASDAQ or tech stocks until we're above the 21-day, above the 50-day line, and maybe above llast week's highs, because there's a lot of technical action there, to get above that. And then you might start feeling more confident. But it's definitely been a NASDAQ and a tech sector that has been not resilient, very quick to run, as whenever something goes bad.
Yeah, and multiple areas that we are seeing resistance, whether it's price levels, moving averages. So there's a lot to overcome here. There are some bright spots, which we will get to, but now let's shift our attention to what's really impacting tech stocks right now, and that is the 10-year Treasury yield. What insight can you provide our audience there? Because that's definitely weighing on a lot of these tech stocks right now.
Yeah, from the perspective for investors who have not, started in early 2020, this is like the highest of all time. But as you can see, there is much further. I mean, we've sort of been in a 40-year downtrend in yields, but they've been coming up sharply. And why does that affect tech stocks? Well, a lot of these growth stocks, you're discounting, future growth. You're predicting 10-year growth. And yes, it's not that big now, but in 10 years, it'll be huge. Well, you discount based on the interest rates to a certain extent. So if the interest rates rise, you're going to be discounting that future growth. And there's also just the basic option. You can go for a safe return in a treasury that's now yielding 1.7 versus essentially nothing a few months ago. Not saying that's the greatest return, but it is safe. And at the margins, that pushes people out of stocks into treasuries.
Yes. So that's something to keep tabs on to provide more context as to what's really going on underneath the surface. And speaking of providing additional context to the market, we do want to check in on the Dow Jones Industrial Average, as well as the S&P 500 and Russell. But starting off here with the Dow, Ed, we were talking about how this blue chip index was holding up, not in correction mode like the NASDAQ, hitting highs, but then it started to become extended. Investors, should they be worried at this point with how the Dow finished out the week?
Well, I think to one extent, it's just in general, it's hard to know with this split market, which is very unusual. Are the Dow and S&P going to pull up the NASDAQ, or the NASDAQ going to pull down the Dow and S&P? I know they often flip, which is rising, which is falling, but there's still a general trend. It fell. I mean, oil prices tumbled on Thursday, and then on Friday there was some news that hit financials. So that wasn't, great news, but it's still, I mean, it closed around its 10-day line. Right now, you shouldn't be too concerned about the Dow. Uh, you know, Obviously you want it to go up and up and up, but it's like you can't go up every day, and it had gone on a long winning streak. So it fell a little bit for the week, not too
Mhm.
bad, all in all.
And as you were saying, with the NASDAQ living below the seemingly like the shorter term moving averages, it's definitely not the case here for the Dow, still well above that 21-day line, which is key. The S&P 500, on the other hand, is a bit closer to that level, trying to find support at the 21-day.
Yeah, and it actually closed a little bit lower. I mean, I think SPY was a little bit out of date. We fell about 0.2% or so, but we held above the 21-day line. It undercut, but it came here, and so that's okay. It's still living there. It'd be great if it were doing a little stronger, but the combination of techs being weak, energy stocks had a really bad week because energy prices fell sharply. I mean, they did rebound today a little bit, but it was still a very bad week. That's a couple of huge sectors for the S&P, and then financials didn't do great today. And so this is sort of a better picture of the market because honestly, the last week or two, all the new breakouts, I think another concern is that breakouts, whether they're tech stocks or not, most of
Right.
them has sort of struggled in the past week or two. And that's not terrible. I mean, some of them have broken out and moved a little higher. Some have sort of broken out, sort of rolled over back to the buy point. I mean, nothing, terrible, but it makes it harder. If chances are it's harder to win on a stock now. And if you don't win big on a stock, then it just makes it very difficult to have net gains in this kind of market.
That's for sure. And let's take a look at IWM, which tracks small caps, finishing off the week, as we said earlier, with a decent gain, pulling back to its own 21-day line, had a pretty huge move off of that short-term bottom edge.
Yeah, and so this one's going to be more volatile, but ultimately it sort of
Mhm.
looks like the Dow and the S&P sort of big rallies and pulled back a little bit, but small cap still looks solid despite a down week.
All right. Well, shall we take a look at some individual stocks?
Sure.
Let's kick things off here with Dick's Sporting Goods, ticker DKS. Had a pullback to its 10-week line or the 50-day line on the daily chart, whichever one that you're looking at. They correspond to each other. Rebounded off of that level, continuing higher, and also relatively recently had its quarterly earnings report. So it's been on the move higher since the earnings came out
Yeah, I didn't
after
have
an
an
initial struggle.
initial reaction wasn't great, but then it came right back and it moved higher. The volume wasn't great. It picked up seemingly right at the end. We had quadruple witching today, so there might still be volume flowing into some of these stocks. Uh, this consolidation was a little short, but actually, if it had been 1 day longer, it would have on the weekly chart. It would have been a cut base, and so it was actionable from that standpoint. And the relative strength line on a daily and a weekly, it's hitting new highs. If this were shown as a base, this would have shown up as a blue dot. It's essentially a blue dot stock. I mean, it just didn't quite register as a base. But when the relative strength line can break out, uh, you know, while the stock is in a base or breaking out, that's really bullish. It really shows leadership at that time.
Yeah, and while a lot of tech stocks are breaking down, Dick's Sporting Goods in a nice uptrend here, finding support at those key moving averages and presenting an actionable buying opportunity. So do you think that the outlook is looking a little bit more sunny for some of these retail names?
Well, you can imagine. I mean, you can imagine sports are probably going to be schools. A lot of places. I mean, some places never really close down, but you can imagine people are just going to be able to play sports more often, and people are going to be able to go into the stores. I know that their digital business has picked up quite a bit, but yeah, it's really important, to get those stores open and getting people in, and so the environment is definitely stronger. But you can see that they also have had some pretty good numbers in recent quarters.
Mhm.
So they've done pretty well in this environment, and probably going to do okay going forward. Though to be fair, the estimates are a little weaker here. I mean, that's something to note, is that it doesn't have tremendous estimates going forward.
Well, we'll keep that in mind. And pivoting to a big cap tech name, because not all of tech is breaking down in a bad way. Facebook actually had a pretty strong week of outperformance, gaining 8% for the week. So that seems pretty surprising, Ed, when tech broadly, we've been saying, isn't really the sandbox that seems exciting to want to play in right now. But here we have Facebook really perking up.
Yeah, I mean, obviously, Facebook was not exactly one of those techs that was skyrocketing a couple of months ago.
Before.
It had been lagging for quite a while. So there is some of that. And you can see that with the relative strength line, though the RS line did hit its highest level of the year today. Today Mark Zuckerberg came out and said, well, he sort of downplayed the impact of Apple new privacy rules, like some of the things that banning cookies or other things that's going on, downplayed the impact on Facebook's advertising business, and that's been a big concern. The earnings have picked up. The estimates are looking pretty solid here. So while it's not above the buy point here, they're going back, and you can sort of see it better on a weekly. You'd have to go all the way back here, but it did get above this level, suggesting an early buy point here if you wanted to. Obviously, with the market being sort of sluggish, it wouldn't be surprising for Facebook, which hasn't gone on big runs lately, to pause here, especially if the Nasdaq struggles. So you could buy here at an early entry, but knowing that there's a risk that it could pull back. You could also wait to see if it forms a handle.
Yeah, handles, those are always nice. We always like the look of those. And right now it is still within 10% of the 10-week line. So if you wanted to size your position off of that, because of course, whenever you are buying a stock, we always like to stress that it's important to have your exit strategy as well, because we can't predict market conditions and how that might weigh on stocks. You said, if the Nasdaq gets hit, so we always want to have that line in the sand just in case a trade heads south.
That's right.
Okay, and last but not least, in terms of individual stocks, we want to highlight is Novacure, ticker NVCR. This is a stock that had a very nice move in 2020, but a number of weeks ago triggered a sell signal by slicing through its 10-week line, also the 50-day line on the daily chart. Some investors, maybe who bought last year and experienced that awesome run, and like the story here, maybe they had a hard time letting Novacure go when it did trigger those sell signals. And maybe if they think now we're seeing some signs of life, what would you say to them?
Yeah, I mean, I actually own this for a while. So, I mean, I love the story, about electrical field to disrupt cancer. It sounds great. But I eventually sold out. But the issue here is that it sold off really hard, heavy volume, really sharp drop, like a lot of other tech and sort of the biomed kind of situations. But what it's been coming up is you can see the volume has been coming down, and this is something that David Ryan, a special guest on IVD Live a couple of days ago, was really pointing out. A lot of the tech names are coming up in this lighter volume, not really regaining a huge amount of the price loss, and on lower volume. That just doesn't suggest much institutional support. It's coming up to this area, the 21-day line. This might be an area where investors might want to who didn't sell before might sell. It's actually sort of close to where this crash came in, so you're not too far off of that, because there's just a risk of it rolling over again. Obviously, if the Nasdaq takes off, then you would imagine it going up, but you just have to sort of play the odds. This is not a positive technical picture. This volume is probably due to some options trade. I don't think it was up until a few minutes ago. So that trade, just generally, you want to be just playing the odds and preserving your capital in a weak market for techs.
That's right. These wedges can be very bearish. And the other thing that David Ryan was saying, that stocks in uptrends, they have nice moves and then they drift lower to come to their moving averages, find support off of those levels. And so this wedging type action is not what a stock that's in a healthy uptrend, how those stocks typically act.
That's a good point about good stock. If you treat this like, if you flip this upside down, you could almost like, oh, this is a cup. and it rallied off the bottom, and now it's forming a handle. I mean, not saying that's like, it's almost setting up like a short type of situation in that regard, because
Mhm.
it's like it's doing the exact opposite what you would want to see in a good stock.
We love getting into the nitty gritty of the technicals at IBD broadly and on this show, and as well as IBD Live. It's a great opportunity to do that in long form. So there clearly is a lot of damage out there on a lot of stocks. Maybe they did show some signs of life off of their recent lows lately, but that doesn't mean that those are the stocks that you want to be buying right now, Ed.
Yeah, and to be honest, in the last couple of weeks, not a lot of breakouts have struggled. I mean, even the reopening plays. I mean, because the major averages, they all sort of slumped this past week, so it's not surprising. So you just have to keep in mind, it's like in a choppy market, it's really difficult. You're probably going to have fewer stocks win, and the ones that win may not go up that much. I mean, there was Williams Sonoma, which skyrocketed off earnings, but most things have either sort of risen a little bit, then come back to the buy point, or maybe they're like up 6%. But if you're only winning 3 out of 10 trades or 2 out of 10 trades, you're probably going to be losing in that environment. It's just different. In a good market, you can afford to not pick many good stocks. Hopefully you will pick mostly good, mostly win most of your stocks, but you can afford to win on less than half of your stocks and still make a decent return for the year. It's just really hard to do that. So I think investors should generally try to be having a relatively modest exposure overall, and really be careful about tech stocks, and really not try to avoid anything that's below the 21 and 50-day lines.
So for recent buys that are, the cyclical or a new economy plays, would you think that maybe taking profits quicker and cutting losses quicker in this difficult market might be the way to go?
Yeah, it probably is. And I think just keeping the exposure light, because it's like, it's just going to be chopping around. You can see how quickly the indexes are rising and falling, especially the Nasdaq, but all of them rising and falling with little news. And it's not an environment that is going to reward you. You could get away with so much. I mean, if you sat around, oh, the stock went down a little bit, chances are it's back up the next day because the market's flying. This isn't that kind of environment. The Nasdaq might fall 3% again, and then and the S&P might fall 1.5%. Your stocks are going to fall in that environment. So you have to be careful with that. Um, but I think the key is, in many ways, is just to be still stay engaged. I mean, I think is there are a lot of stocks that are not far from buy points. I mean, whether it's
Mhm.
real economy or a lot of chip names, a lot of them are looking close. We just need a few good days, but you want to be watching these different sectors so you're prepared for it, if the market really does turn. But it's not necessarily, it hasn't really proven itself right now.
That's right. As always, keep that watch list fresh, stay on the edge of your seat, monitor those changing market conditions. And as we discussed at the beginning of this segment, we have those key levels to watch on each of the major indexes. So that can help us provide some clues, as well as the individual holdings that you have in your portfolio and the action of leading stocks. Thank you, Ed, for that analysis. And if you haven't checked out Leaderboard Free Access Week, make sure to do so. We're getting towards the end of free access, but still definitely worth checking out. There was a lot of movement on the leaderboard this weekend.
Yeah, and that's because they try to stay flexible as well. They try not to be impulsive, but the market's turning around, and the markets team really does a good job of reacting to that.
That's right. So on the homepage of investors.com, you can see the banner there for free access. So hope you check it out. And the analysis is going to continue on investors.com over the weekend. Ed always puts out insightful pieces, help you get ready for the week ahead as an investor, and helps us stay in tune with all the underlying action, the stocks that you need to be watching, and all of our weekly features, of course, worth checking out as well. You can check it all out from your phone if you download the IBD app and get push notifications. That makes it super easy. Speaking of staying engaged, Ed, that's a great way to do it. And IBD Live will be back Monday morning for more in-depth market and stock analysis. We'll see you then. Have a great weekend.